Here is a number that will change everything you think about money. If you had put just $10,000 into the S&P 500 index in the year 2005 and did nothing but sit there, you would have $71,750 today. That is more than 7 times your original money. You did not work extra hours. You did not start a business. You did not get lucky with some secret investment. You simply bought the market and waited. But here is the part that makes me angry. The average investor earned only 16.54% in 2024, while the stock market returned 25.02%. That is a gap of 848 basis points. This gap represents the fourth largest underperformance since they started tracking this data in 1985. And do you know why this happens? Because most people do not know what I am about to teach you in the next hour. They buy when they should sell. They sell when they should hold. They panic when they should be calm. And they sit in cash when they should be invested. But not you, not anymore. Today, I am going to give you everything you need to build serious wealth through the stock market. No complicated strategies, no expensive advisors, no gambling on hot tips from your cousin's friend who works in finance. Just simple, proven methods that have created more millionaires than any other wealth-building tool in human history. Here is what we will cover. First, I will explain why the stock market is the greatest wealth-building machine ever invented. I will show you the actual numbers that prove this beyond any doubt. Second, I will teach you the exact method that beat Wall Street's smartest hedge fund managers, a method so simple that a 10-year-old could do it. Third, I will reveal the psychological traps that destroy most investors and how to avoid them completely. Fourth, I will give you the specific steps to start investing today, even if you only have $50. And fifth, I will share the secret that turned ordinary janitors, secretaries, and teachers into millionaires. This is information that Wall Street does not want you to know. Are you ready? Let us begin. Before we talk about how to invest, you need to understand why the stock market is so powerful. When you buy a stock, you are buying a piece of a real company. You become a partial owner. Plus, if you buy one share of Apple, you own a tiny piece of every iPhone sold, every MacBook manufactured, every App Store transaction processed. Plus, if you buy one share of Coca-Cola, you own a tiny piece of every can of Coke consumed around the world, every Sprite bottle purchased at a convenience store, every Fanta enjoyed at a birthday party. These companies work for you 24 hours a day, 7 days a week, 365 days a year. Their employees show up to work. They create products. They sell services. They make profits. And as an owner, those profits belong to you. This is the magic of stock ownership. You are making money while you sleep. Now, some people think the stock market is like a casino. They could not be more wrong. In a casino, the odds are always against you. The house has a mathematical edge. The longer you play, the more certain it is that you will lose. The stock market is the opposite. The S&P 500 has averaged roughly 10% annual returns over the past 97 years. This includes every crash, every recession, every world war, every pandemic. Through all of it, the market has gone up. Think about that for a moment. We lived through the Great Depression. The market recovered. We lived through World War II. The market recovered. We lived through the 2008 financial crisis. The market recovered and reached new highs by 2013. We lived through the COVID pandemic when the market dropped 34% in just 1 month, and the market recovered in just 4 months and ended the year up more than 16%. The stock market is not a casino. It is a wealth-creating machine that has never failed to reward patient investors. But here is the key word: patient. Research from Morningstar analyzing 150 years of stock market data shows that the market always recovers from crashes, every single time, without exception. If you had invested $100 at the beginning of the year 2000, that money would be worth more than $300 today, despite living through the dot-com crash, the 2008 financial crisis, and the COVID crash. And if you had invested $100 back in 1870, that would be worth over $3,400,000 today. Let that sink in. Now, let me tell you about a bet that changed how the world thinks about investing. In 2007, Warren Buffett made a $1 million bet. He is one of the richest people on earth. He has been investing for 7 decades. He knows more about money than almost anyone alive. And his bet was simple. He said that a basic, boring S&P 500 index fund would beat a carefully selected group of hedge funds over 10 years. Hedge funds! These are the funds managed by the smartest people on Wall Street. They charge enormous fees. They have teams of analysts, supercomputers, and access to information that regular people cannot get. Their managers earn millions of dollars per year. A man named Ted Seides from a company called Protege Partners took the other side of the bet. He selected 5 hedge funds. These were not random funds. These were carefully chosen, professionally managed investment vehicles run by financial geniuses. So what happened? Over the 10 years, the simple S&P 500 index fund returned 125.8%. The hedge funds? Their returns ranged from 2.8% to 87.7%. The index fund crushed them. It was not even close. The S&P 500 averaged 7.1% annually, while the hedge funds averaged only 2.2%. Buffett explained why this happened. He said making money on the stock market does not require great intelligence, a degree in economics, or familiarity with Wall Street jargon. What investors need instead is an ability to ignore mob fears and enthusiasms and to focus on simple fundamentals. He also said something very important. Stick with big, easy decisions and avoid activity. This is the secret that I want you to remember throughout this entire video. The best investors are the ones who do the least. They buy, they hold, they wait, they ignore the noise, and they get rich. But there is another reason why the hedge funds lost: fees. According to a study by LCH Investments, since the beginning of hedge funds in 1969, investors have paid nearly half of their profits as fees. Half. Meanwhile, index funds charge as little as 0.03%. That is 3 cents for every $100 invested. The difference in expense ratios between actively managed funds and passive index funds is enormous. The average index mutual fund charged an expense ratio of just 0.05% in 2024. The average actively managed equity mutual fund charged 0.64%. That is nearly 13 times more expensive. And this matters more than most people realize. According to Fidelity Research, just a 0.25 percentage point difference in expense ratio could make a 4.5 percentage point difference in total return after 10 years. Fees are like termites eating away at your house. You cannot see them, you cannot hear them, but year after year, they destroy your wealth from the inside. This is why I'm going to teach you how to invest in low-cost index funds. It is the same strategy that beat Wall Street's best, and it is available to anyone, including you. Now, let me explain what an index fund actually is. This is critical knowledge. An index fund is like a basket that holds pieces of many different companies. Instead of picking individual stocks, which is extremely difficult even for professionals, the fund automatically buys shares of all the companies in a specific list. The most famous list is the S&P 500. This is a collection of approximately 500 of the largest companies in America. Plus, we are talking about companies like Apple, Microsoft, Amazon, Google, Tesla, NVIDIA, Johnson & Johnson, JP Morgan Chase, Visa. These are the biggest, most successful companies in the world. When you buy one share of an S&P 500 index fund, you instantly own a tiny piece of all 500 of these companies. Think about how powerful that is. You do not need to research which company will do well next year. You do not need to predict which technology will become popular. You do not need to analyze financial statements or understand accounting. You simply buy the entire market. And history shows that the market, over time, always goes up. The historical average yearly return of the S&P 500 is 9.466% over the last 150 years. Over the last 30 years, it is 10.439% with dividends reinvested. But here is something beautiful about index funds. They are self-cleaning. Plus, when a company in the index starts to fail and becomes too small, it gets removed automatically. Plus, when a new company grows big enough to qualify, it gets added automatically. Plus, when Blockbuster Video disappeared, it was removed from the index and Netflix took its place. Plus, when Kodak fell, companies like Apple expanded their positions. You do not need to do anything. The index naturally keeps the best companies and removes the worst ones. This is called passive investing, and research shows it beats active investing almost every time. According to Warren Buffett himself, active investors in aggregate will always underperform passive investors after costs. The math is simple. Both groups own the entire market, but active investors pay higher fees, so they must end up with less money. This is not opinion. This is mathematics. Now, there are many index funds you can choose from. Let me tell you about some of the most popular ones. The Vanguard S&P 500 ETF, ticker symbol VOO, tracks the S&P 500 and has an expense ratio of just 0.03%. Since its launch in 2010, it has averaged 12.7% annual returns. The SPDR S&P 500 ETF Trust, ticker symbol SPY, is the oldest and most traded S&P 500 fund. It has an expense ratio of about 0.09%. The iShares Core S&P 500 ETF, ticker symbol IVV, is another excellent option with extremely low fees. All of these will give you similar results. The differences are tiny. What matters is that you pick one and start investing. Later in this video, I will give you the exact steps to open an account and buy your first shares. But first, we need to talk about the most powerful force in wealth building. Albert Einstein, one of the smartest humans who ever lived, allegedly called compound interest the eighth wonder of the world. Whether or not he actually said this does not matter. What matters is that compound interest is magical. Let me explain how it works. Imagine you invest $1,000, and let us say it earns 10% per year. After year one, you have $1,100. You earned $100. Now here's where it gets interesting. In year two, you earn 10% on the entire $1,100, not just your original $1,000. You earn interest on your interest. After year two, you have $1,210. You earned $110. $10 more than year one. After year three, you have $1,331. After year five, $1,610. After year 10, $2,594. Your money has more than doubled in just 10 years, but the real magic happens over longer periods. After 20 years, your $1,000 becomes $6,727. After 30 years, your $1,000 becomes $17,449. After 40 years, your $1,000 becomes $45,259. From $1,000 to over $45,000 just by sitting and doing nothing. This is the power of compound interest. It is like a snowball rolling down a hill. At first, it is small and slow. But as it picks up more snow, it gets bigger. And the bigger it gets, the faster it picks up even more snow. The rule of 72 is a quick way to understand this. You divide 72 by your expected return, and that tells you how many years it takes for your money to double. At 10% returns, your money doubles every 7.2 years. At 7% returns, it doubles every 10.3 years. At 12% returns, it doubles every 6 years. Now think about this. If your money doubles every 7 years and you start at age 25, by age 32, you have doubled your money. By age 39, you have quadrupled your money. By age 46, you have 8 times your money. By age 53, you have 16 times your money. By age 60, you have 32 times your original investment. This is why starting early is so important. Let me show you an example that makes this crystal clear. A study from Britannica Money compared two investors. Let us call them Amelia and Ben. Amelia started investing at age 25. She contributed consistently for 40 years. When she retired at age 65, she had $1.1 million. She became a millionaire. Ben started investing at age 35, just 10 years later than Amelia. He contributed the same amount for 30 years. When he retired at age 65, he had only $412,000. That 10-year delay cost Ben $700,000. Do you understand now why time is your most valuable asset? The best time to start investing was yesterday. The second best time is today. Now, I need to tell you something that might shock you. Dalbar, a research company that has studied investor behavior for over 3 decades, found that the average investor dramatically underperforms the market. Over 20 years, the average equity investor earned an annualized return of 8.7%, while the S&P 500 delivered 9.7%. 1% difference? That does not sound like much, right? Wrong. That 1% difference on a $1 million initial investment would mean having $5.3 million instead of $6.3 million after 20 years. That is a $1 million difference. Over a 30-year period, the average equity fund investor made 7.13% versus the S&P 500, which returned 10.65%. That 3% difference means the average investor would have $800,000 at the end, while simply buying and holding the index would give you over $2 million. Why does this happen? Dalbar identified 9 psychological traps that destroy investor returns. Number 1, loss aversion. This is when investors expect to find high returns with low risk. They cannot accept that all rewards come with risks. Number 2, narrow framing. This is when investors make decisions without considering all implications. Plus, they panic and sell their stocks during a crash without thinking about how they will know when to buy back in. Number 3, mental accounting. This is when investors take crazy risk in one area while avoiding reasonable risk in another. Plus, they might gamble their entire savings on a meme stock while being too scared to invest in a diversified index fund. Number 4, diversification confusion. This is when investors think they are reducing risk by simply using different sources. Plus, they buy 10 different technology stocks and think they are diversified when they are actually just concentrated in one sector. Number 5, anchoring. This is when investors relate to familiar experiences even when they are inappropriate. Plus, they remember that their uncle lost money in the market 20 years ago, so they assume they will too. Number 6, media response. This is when investors react to news without reasonable examination. Plus, they hear a scary headline about the economy and immediately sell everything without doing any research. Number 7, regret. This is when investors treat errors of commission more seriously than errors of omission. Plus, they feel worse about buying a stock that drops than about failing to buy a stock that rises, even though both mistakes cost the same money. Number 8, herding. This is when investors copy the behavior of others even when it produces bad outcomes. Plus, they see their friends buying crypto at all-time highs, so they do the same and then lose money together. Number 9. Optimism. This is when investors believe good things happen to them while bad things happen to other people. Plus, they think they can time the market even though all the research shows that almost nobody can. These psychological traps are dangerous. And the worst part? You cannot simply decide to avoid them. They are built into human nature. They have helped us survive for hundreds of thousands of years. But in the stock market, they destroy wealth. Research from J.P. Morgan Asset Management reveals something shocking about what happens when investors try to time the market. If you invested $10,000 in the S&P 500 in January 2005 and stayed invested until December 2024, you would have $71,750. But if you missed just the 10 best market days during that period, your investment would be worth only $32,871. You lost nearly half your wealth by missing just 10 days out of 20 years. And it gets worse. If you missed the 20 best days, your return dropped to just 3.69%. If you missed the 30 best days, your return was only 1.53%. If you missed the 60 best days, your return was negative 3.7%, and your $10,000 became only $4,712, less than you started with. Here's the secret that explains why this happens. 7 of the stock market's 10 best days occurred within just 15 days of one of the market's 10 worst days. Do you understand what this means? The best days happen right after the worst days. When you sell during a crash because you are scared, you miss the recovery. During the 2008 financial crisis, the market fell 38% from September 2008 to March 2009. But 7 of the market's 10 best days over the past 2 decades happened during that same period. During the COVID crash in 2020, the market had its 2 largest drops in decades, but it also had 3 of the market's 10 best days in that same period. This is why trying to time the market is impossible. You cannot predict the worst days, and if you sell during the worst days, you will almost certainly miss the best days that follow. The solution? Stay invested. Do not try to be clever. Do not try to predict the market. Just buy and hold. The data is clear. The investors who perform best are the ones who do the least. Now I'm going to tell you about some ordinary people who became millionaires using these exact principles. According to The Motley Fool, there are countless examples of people with limited means who became millionaires through patient investing. Ronald Read was a janitor and gas station attendant in Vermont. He never earned a big salary. He never inherited money. He never won the lottery. But he consistently invested in stocks throughout his life and let compound interest work its magic. When he passed away, he left behind $8 million. $8 million from a janitor! How did he do it? He bought good companies. He held them for decades. He reinvested his dividends, and he never panicked during market crashes. According to financial research, Ronald Read built his wealth by consistently investing in blue-chip stocks. His wealth was built by buying quality, holding for the long term, and reinvesting every dividend. There are thousands of stories like this. Secretaries who left millions to charity, teachers who funded scholarships, ordinary people who did extraordinary things with their money, simply by being patient and consistent. If they can do it, so can you. All right, let me now talk about something that scares many people away from investing: market crashes. Since 1950, the S&P 500 has declined by 20% or more on 13 different occasions. The average crash sees a decline of about 33%, and the average length of a crash is 338 days. That sounds terrible, right? But here's what you need to know. The bull markets that follow crashes are much stronger and last much longer than the crashes themselves. After Black Monday in 1987, when the market lost over 20% in a single day, it took only 2 years for the market to recover completely. After the 2008 financial crisis, the S&P 500 took about 6 years to fully recover. But then it went on to create one of the longest bull markets in history. After the COVID crash, when the market fell 34% in just 1 month, it recovered in only 4 months and reached new all-time highs by the end of the year. Every single crash in history has been followed by a recovery and new all-time highs. Every single one. Research analyzing 150 years of market history confirms this. Even after the worst crash in history, the crash of 1929 that led to the Great Depression, even that eventually led to new highs. Here is how you should think about market crashes. They are like sales at your favorite store. When prices go down, you can buy more for the same money. And when prices go back up, you make more profit. Think about it like buying groceries. If eggs normally cost $5 and suddenly they are on sale for $3, you do not panic and stop buying eggs. You buy more eggs because they are cheaper. Plus, think about it like buying clothes. If your favorite jeans normally cost $100 and suddenly they are 40% off, you do not run away from the store. You buy more jeans because it is a great deal. The stock market is the same. When prices drop, you are getting more shares for your money. And when prices recover, and they always recover, you end up with more wealth. The data is clear. After the 10 worst calendar year returns over the past 50 years, the market has always recovered and gone on to deliver strong, positive returns. Crashes are temporary. Wealth building is permanent. Your job is simple. Do not sell during crashes. If possible, buy more during crashes and wait for the recovery. Now let us talk about something that destroys wealth silently, something you might not even notice: inflation. Inflation is the rate at which prices increase over time. When inflation is 3%, it means things that cost $100 today will cost $103 next year. This might not sound like much, but let me show you what happens over time. At just 3% inflation, the cost of everything doubles in about 24 years. Something that cost $10,000 in 1980 would cost over $35,000 today. That is the compounding effect of inflation at work, slowly turning your dollars into dimes without touching your account balance. Keeping money in a savings account. If your savings account pays 1% interest and inflation is 3%, you are actually losing 2% purchasing power every year. Your bank balance might look the same, but the real value of that money is shrinking. According to the Federal Reserve Bank of St. Louis, during periods of high inflation, Americans have lost trillions of dollars in purchasing power on their cash savings. According to Bankrate, moving from a 0.01% savings account to a 4.50% high-yield account on $10,000 saves you approximately $449 annually in lost purchasing power. But even high-yield savings accounts usually cannot keep up with stocks. The stock market has historically returned around 10% annually. After adjusting for the average 3% inflation, that is still about 7% real growth.
This means stocks do not just protect you from inflation, they help you beat it and actually grow your purchasing power. But here is an important point. You still need some cash for emergencies. Financial experts recommend keeping 3 to 6 months of living expenses in a savings account. This is your safety net. If you lose your job or have an unexpected expense, you do not want to be forced to sell your stocks at a bad time. Think of it this way. Your emergency fund is like insurance. Your investments are for wealth building. They serve different purposes. Keep enough cash to sleep at night. Put the rest in the market. Now I want to teach you about something called dollar cost averaging. This is one of the most powerful investment strategies for regular people. Here is how it works. Instead of trying to figure out the perfect time to invest a large sum of money, which is basically impossible, you invest a fixed amount at regular intervals. For example, you might invest $200 every month on the 15th, regardless of what the market is doing that day. Or you might invest $50 every week on Friday when you get your paycheck. The amount and timing do not matter much.
What matters is consistency. Here is why this strategy is so powerful. When the market is high, your $200 buys fewer shares. When the market is low, your $200 buys more shares. Over time, you end up buying more shares when prices are cheap and fewer shares when prices are expensive. This automatically lowers your average cost. Research from a 40-year study comparing different investment strategies found that dollar-cost averaging helped investors achieve better returns during unfavorable market conditions. An investor who started investing at a market peak, the absolute worst time to begin, but used dollar-cost averaging, saw an average annualized 10-year return of 10.4%. Compare that to keeping money in cash, which only returned 3.1%. Even with terrible timing, dollar-cost averaging delivered excellent results. Now, some academic research suggests that if you have a large sum to invest, putting it all in the market immediately, called lump sum investing, typically beats dollar-cost averaging about 2/3 of the time. This makes mathematical sense. Since the market goes up more often than it goes down, having your money invested sooner means more time for it to grow. But here's the thing. Dollar-cost averaging is not just about mathematics, it is about psychology. Many people who try to invest a lump sum end up paralyzed by fear. They wait for the perfect time to invest. They keep thinking the market might drop tomorrow, and they end up keeping their money in cash for years, missing out on tremendous growth. Dollar-cost averaging removes this fear. You do not need to make a big decision. You just set up automatic investments and let them run. According to behavioral finance research, dollar-cost averaging reduces investor anxiety and helps people stay committed to their investment plan. This psychological benefit often outweighs any mathematical disadvantage. The best investment strategy is the one you will actually follow. And for most people, dollar-cost averaging is easier to follow than lump sum investing. All right, now I am going to give you the exact steps to start investing today. This is the practical part you have been waiting for. Step 1. Build your emergency fund first. Before you invest a single dollar in the stock market, make sure you have 3 to 6 months of living expenses saved in a bank account. This money should be easily accessible. It is your safety net for unexpected events. If you lose your job, you can use this money to pay rent while you find a new one. If your car breaks down, you can fix it without selling your investments at a bad time. If you have a medical emergency, you can handle it without going into debt. Calculate your monthly expenses: rent, food, utilities, transportation, insurance, and multiply by 3 for a minimum emergency fund, or 6 for a more comfortable cushion. Step 2. Pay off high-interest debt. If you have credit card debt charging 20% interest, paying that off is like getting a guaranteed 20% return on your money. No stock market investment can promise that. Focus on debt with interest rates above 7 to 8%. This includes most credit cards, personal loans, and payday loans. Do not worry about paying off low-interest debt like mortgages or student loans before investing. The math usually works out better if you invest while making minimum payments on low-interest debt. Step 3. Open a brokerage account. You need a place to buy stocks and funds. There are many good options, including Fidelity offers 0 minimum to open an account and has excellent customer service. Charles Schwab provides great research tools and has merged with TD Ameritrade. Vanguard is known for having some of the lowest cost index funds in the industry. Robinhood, Webull, or other mobile-first apps are popular with younger investors and offer user-friendly interfaces. All of these options work well. The differences between them are small. Pick one and move forward. Step 4. Choose your index fund. For most people, I recommend starting with an S&P 500 index fund. Here are the most popular options. VOO. Vanguard S&P 500 ETF. Expense ratio 0.03%. SPY. SPDR S&P 500 ETF Trust. Expense ratio, about 0.09%. IVV. iShares Core S&P 500 ETF. Expense ratio, 0.03%. FXAIX. Fidelity 500 Index Fund. Expense ratio, 0.015%. According to the Investment Company Institute, the average index mutual fund charged an expense ratio of just 0.05% in 2024. Look for funds with expense ratios at or below this level. If you want more diversification, consider a total stock market fund like VTI. Vanguard Total Stock Market ETF, which includes smaller companies in addition to the S&P 500. Step 5. Set up automatic investments. Most brokerage accounts allow you to schedule recurring purchases. Set up automatic transfers from your bank account to your brokerage account and automatic purchases of your chosen index fund. This could be $50 per week, $200 per month, or whatever you can afford. The exact amount matters less than consistency. Once you set this up, do not touch it. Let the automation do its work. This removes emotion from your investing and ensures you buy consistently over time. Step 6. Use tax-advantaged accounts. If your employer offers a 401k plan with matching contributions, use it. This is free money. If your employer matches 50% of your contributions up to 6% of your salary and you earn $60,000, contributing 6% means $3,600 per year from you, plus $1,800 from your employer. That is a 50% instant return before any market gains. If you do not have a 401k, open a Roth IRA or traditional IRA. These accounts offer significant tax advantages that help your money grow faster. According to research from Vanguard, 401k investors saw an average annual return of 9.7% over 5 years. Tax-advantaged accounts can add significant value to your long-term wealth. Step 7. Hold and do not panic. This is the hardest step, and it is also the most important. When the market drops 10%, do not sell. When the market drops 20%, do not sell. When the news is full of scary headlines, do not sell. When your friends are panicking, do not sell. Remember what we learned earlier. Staying invested through the worst days is crucial because the best days happen right after the worst days. According to J.P. Morgan research, the S&P 500 has suffered an average intra-year pullback of 14% over the past 4 decades. Yet it still managed to post a positive return in 31 of those 40 years. Drops are normal. Crashes are normal. They are the price of admission for long-term wealth building. Your job is to hold through them. Now let me address some common mistakes that I want you to avoid. Mistake number 1. Trying to pick individual stocks. I know. Everyone thinks they can find the next Amazon or Tesla, but the data is brutal. According to research, most professional fund managers fail to beat the market over long periods. And these are people who do this full-time with access to information and tools that regular investors cannot get. If the professionals cannot beat the market consistently, what makes you think you can? Stick with index funds. Own the entire market. Stop trying to be clever. Mistake number 2. Checking your portfolio too often. Every time you look at your portfolio, you give yourself an opportunity to make an emotional decision. And emotional decisions in investing are almost always bad decisions. Research shows that investors who check their portfolios daily make more trades and earn lower returns than investors who check quarterly or yearly. Set up your automatic investments and then walk away. Check your portfolio quarterly at most, preferably less. Mistake number 3. Selling during crashes. We have already covered this, but it bears repeating. Investors who sold during market crashes often miss the recovery that followed. If you had sold everything on September 29, 2008, when the market fell 8%, you would have avoided 5 heavy loss days. But you would have also missed 7 excellent market upswings, with returns ranging from 6% to 11% per day. The cost of missing those recovery days is enormous. Do not sell during crashes. Mistake number 4. Waiting for the perfect time to invest. There is no perfect time. The market will always feel uncertain. There will always be reasons to wait.
Waiting for a crash means you might wait for years while the market goes up without you. Waiting for stability means you will wait forever because stability never truly arrives. Historical research shows that the S&P/TSX has delivered an annualized return of 9.1% since 1956. Time in the market beats timing the market. Start now, today, with whatever amount you can afford. Mistake number 5. Paying high fees. Even small differences in fees compound into massive differences over time. If you invest $5,000 in a fund with a 0.05% expense ratio, you pay $2.50 per year in fees. But if you invest in a fund with a 0.64% expense ratio, you pay $32 per year. Over decades, these differences compound into thousands of dollars. Always check expense ratios. Always choose low-cost index funds. Never pay more than necessary. Mistake number 6. Listening to financial media. Financial news exists to get clicks and views, not to help you invest wisely. Headlines like, "Market crash coming," sell advertising. Headlines like, "Stay invested and be patient," do not sell advertising. The financial media is incentivized to make you scared and active. But being scared and active destroys wealth. Turn off the financial news. Unsubscribe from stock tip newsletters. Stop watching market commentary videos. Except this one, of course. Now let me talk about how to increase your investment amount over time. You started with $50 per month. Great. But you should not stay at $50 per month forever. As your income grows, increase your investments. A good rule of thumb is to save at least 15 to 20% of your income for retirement. If you get a raise, increase your investment amount by at least half of the raise. If you pay off a debt, redirect those payments to your investments. If you receive a bonus or tax refund, invest a portion of it. The data from NASDAQ shows the difference that contribution amount makes. Investing $500 per month at 12% returns could help you reach $1 million in about 21 years. Investing $1,000 per month at the same returns could help you reach $1 million in about 15 years. The more you invest, the faster you build wealth. But even small amounts, invested consistently over long periods, can make you a millionaire. Now let me address a question many people have. Is it too late for me to start? No, it is never too late to start investing. If you are 30, you have 35 years until traditional retirement age. That is plenty of time for compound interest to work its magic. If you are 40, you have 25 years. Still excellent. If you are 50, you have 15 to 20 years. Compound interest can still significantly grow your wealth. According to research, even starting at 50, with 50 to 20 years until retirement, compound interest can significantly grow your wealth. Yes, starting earlier is better, but starting later is better than not starting at all. The truth is, clients who understand and trust the process of compound interest are far more likely to achieve their financial goals regardless of their starting point. The best day to start was yesterday. The second best day is today. Let me now give you a simple framework to guide your investing journey. First, build your foundation. This means emergency fund, paying off high-interest debt, and understanding the basics of how stocks work. You have already learned this today. Second, start small but start now. Even $25 per month is better than nothing. Open that brokerage account today. Third, automate everything. Set up recurring transfers and automatic purchases. Remove yourself from the equation as much as possible. Fourth, increase your contributions over time. As your income grows, invest more. Aim for 15 to 20% of your income going toward investments. Fifth, stay the course during crashes.
Do not panic. Do not sell. Remember that crashes are temporary and recoveries are permanent. Sixth, keep learning. Read books about investing. Listen to podcasts from reputable financial educators. But be careful about taking advice from social media influencers who might not have your best interests at heart. Seventh, review annually, not daily. Once per year, take a look at your portfolio. Make sure your asset allocation still makes sense for your age and goals. Then close the app and do not look again until next year. Before I wrap up, let me share some powerful statistics that should motivate you to take action. According to the historical data, there has never been an 18-year period in the history of the S&P 500 that produced a negative real return. Never. According to the Motley Fool, the index consistently beats inflation over long time horizons. There is no period of at least 18 years that has not produced a positive real return on investment. A typical investment over that period will triple your spending power. Triple your spending power! According to JP Morgan research, a blend of stocks and bonds has not suffered an annualized negative return over any 5-year rolling period over the past 70 years. The data is overwhelming. If you invest in diversified funds, hold for the long term, and do not panic during crashes, you will build wealth. This is not speculation. This is not hope. This is historical fact backed by over a century of data. Let me leave you with some final thoughts. Building wealth through stocks is not complicated. It does not require a finance degree. It does not require insider information. It does not require luck. It requires 3 things. Time. Start as early as possible and let compound interest work for decades. Consistency. Invest regularly, regardless of what the market is doing. Patience. Hold through crashes, ignore the noise, and trust the process. The Dalbar study has shown for 30 years that the biggest obstacle to investment success is investor behavior. Not market conditions, not economic factors, behavior. The investors who perform best are those who set up automatic investments, ignore market fluctuations, and do nothing during crashes. Your job is to be boring. Your job is to be patient. Your job is to do less than you think you should. According to Warren Buffett himself, no consultant in the world will tell you to just buy an S&P index fund and sit for the next 50 years. You do not get to be a consultant that way. But that simple strategy beats the expensive, complicated strategies that Wall Street sells. The financial industry does not want you to know this. They make money from complexity. They make money from activity. They make money from your fear and your greed. But you now know the truth. Buy low-cost index funds. Hold them for decades. Do not panic during crashes. That is it. That is the entire secret to building wealth through stocks. Now, I want you to take action. Today. Not tomorrow, not next week, today. I want you to do one of the following. If you do not have an emergency fund, open a high-yield savings account and set up automatic transfers to start building one. If you have an emergency fund but no brokerage account, open one today. It takes less than 15 minutes. Fidelity, Schwab, Vanguard, pick one and do it. If you have a brokerage account but have not been investing consistently, set up automatic investments today. Start with any amount you can afford. If you already have automatic investments, increase your contribution amount. Even $25 more per month will compound into thousands over decades. Knowledge without action is worthless. Everything I taught you today means nothing if you do not do something with it. The difference between people who build wealth and people who struggle financially is not intelligence. It is not luck. It is action. You now have all the information you need. You understand how stocks build wealth. You know which funds to buy. You understand why patience matters. You know the mistakes to avoid. The only thing left is to start. I started this video with a simple number. $10,000 invested in 2005 becoming over $71,000 today. But that number means nothing compared to what your future could look like. Imagine yourself in 30 years. What kind of life do you want? What kind of options do you want to have? Do you want to retire early and spend time with your grandchildren? Do you want to travel the world and experience new cultures? Do you want to support causes you believe in and leave a legacy? Do you want to simply have freedom from financial stress? All of this is possible. All of this is within your reach, but only if you start. The historical data shows that the stock market has created more wealth for ordinary people than any other investment in history. Research confirms that compound interest, given enough time, can turn modest savings into significant fortunes. Studies prove that simple, low-cost index funds beat complicated, expensive strategies. The path is clear. The evidence is overwhelming. The opportunity is yours. Do not let another day pass without taking action. Do not let fear hold you back. Do not let complexity paralyze you.
The stock market is not a casino. It is a wealth-creating machine that has worked for over 100 years, and starting today, it can work for you.
Thank you for watching this video. Thank you for investing an hour of your time in your financial education. Now go and invest in your future. I believe in you.